Hello everyone to Learn.Invest.Achieve channel. Today we'll talk about BHP Group Limited and find the intrinsic value of its stock. BHP Group Limited is the first international company in this channel, and I made a shorter video of this analysis going over the final results and the intrinsic value only. It's the video right after this one, and you can watch it if you don't have enough time to watch all of this video. First, I really want to thank all of the 408 beautiful subscribers who decided to support this channel and motivate me to make more videos with their subscription to the channel. The second thing, please remember that this video is not financial advice and for entertainment purposes only. BHP Group Limited is an Australian multinational mining public company headquartered in Victoria, Australia. It produces iron ore, copper, coal, nickel, and other commodities. The company is the lowest cost major iron ore producer globally, holds the world's largest copper endowment, the second largest nickel endowment globally, and the company is developing one of the largest potash mines in Canada. This company has only one equity security, and the ticker symbol is BHP. It reports its annual operations in a fiscal year that ends on June 30th. So in less than a month, their 2023 year will end and we will have a fresh annual report and new set of financial statements for 2023. Let's go to the analysis report and start by looking at the 2022 revenue. We can see that about 47% of the revenue came from producing and selling iron ore, 26% copper, 24% coal, and 3% other commodities. Moving on to check the growth of the annual revenue and the operating expenses year over year, we can notice that it's generally increasing since 2016 except for 2020, and probably this decline is the result of the COVID lockdown, which is an expected thing. The other thing we can notice is that the revenue growth is spectacular in 2021 and 2022, and actually most of the financial ratios also jumped in that period. For example, if we look at the gross margins, it jumped 10% in 2021 and then 5% in 2022. My explanation is that the company abandoned the petroleum operations at the beginning of 2021 and focused on what makes more value for them. Moving on to check the company's solvency, we see that the debt to asset ratio is also decreasing since 2015, and in 2022 it's only 17%. This low debt to asset ratio, along with the revenue growth, in my opinion, is an amazing performance, because having only 17% debt to asset ratio means that this company still has so much room for growth backed by debt. Or in other words, it is not difficult for acquiring more mines or other companies using debt, because the creditors will not hesitate to lend them more money, and we can see the proof when we scroll down to see that BHP Group Limited generated 48 times the interest expense they have to make, and the lowest acceptable times interest earned ratio is 7 times, while this company's ratio is 48 times. Moving on to the outstanding shares, this company does not buy back its shares. Other than 2019, they reduced their outstanding shares by about 5%, and the number of shares they are issuing after that is immaterial. Next, we check the dividends. BHP Group has been distributing dividends since 2015, and during the last fiscal year they distributed $3.50 per share. This makes the dividend yield ratio about 5.93% using today's share price of $59. In my opinion, the relatively high dividend yield and affording to distribute the dividend is a major reason that attracts many investors, including me. Moving on to the revenue forecast, in this channel, we try to find the factor that the revenue depends on, or in other words, what does this company need to generate more revenue, and without it, they will be out of business. In this case, since it is a mining company, they need the mines and the equipment to produce iron ore, copper, and other commodities. The mines and the equipment are listed in the balance sheet as assets, so we'll be using the asset to revenue ratio. This ratio has been increasing in the last few years, which is consistent with the revenue growth that we saw on the first tab of this analysis report. To be conservative in our forecast, in my opinion, we should not assume that this ratio will continue increasing in 2023, and it will be the same ratio as in 2022, which is 61%. This will give us about 58 billion revenue for 2023, which unfortunately is less than 2022 revenue by 13%. And this is kind of consistent with the movement of the stock if we look at the price chart, because it went down by about 12% this year. The second forecast key that we need to find the intrinsic value is the free cash flow to the revenue ratio. If we go back to the free cash flow graph, it was 38% for 2021 and 39% for 2022. In my opinion, we should assume that during 2023, the free cash flow to the revenue ratio will also decline, just like the revenue. So we will be using 34% free cash flow to the revenue ratio, which is 13% less than the 2022 ratio, to make it consistent with the revenue decline that we are expecting. The third forecast key is the outstanding shares. In my opinion, we should assume that there wouldn't be any meaningful change, so we'll be using the same as 2022 outstanding shares. Next is the discount rate. Since we're trying to find the intrinsic value at the end of the 2023 fiscal year, which is about 1 month away, we will be using 1 month treasury bill interest rate, that is 5.13%. The fifth and the final forecast key that we need is the return on investment ratio. And we will start by using 5.93%, which is the 2022 dividend yield ratio. These 5 forecast keys will give us about $58 billion in revenue, almost $20 billion in total free cash flow, or $3.90 free cash flow per share. Discounting this number by 5.13% and using 5.93% return on investment ratio, the intrinsic value of this stock is about $62 per share, and using today's share price makes it undervalued by 5%. But if we increase the return on investment ratio to 7%, the intrinsic value will be about $52.80 per share, which make the share overvalued by about 12%. In my opinion, I think the intrinsic value using 7% return on investment ratio makes more sense. As I already mentioned, this company is an international company, so they only publish semi-annual report and the annual report, while the American companies publish the results of their operations every 3 months. In the semi-annual report, the revenue is down by about 16%, which is a confirmation to us because it's consistent to the forecast of this analysis. I really want to hear what you think about this stock and analysis and how we can improve this analysis. Have a great day, more dividend, and more capital gain.